We are back with more of My Southern Home, and I'm here with Jeff Ratanapool with Stockton Mortgage. And Jeff, you know, we're going into the spring season, and we just left really crazy 2021. What do you see going into this year for homeowners and investors that want to buy property?
Yeah, you know, Kimberly, it's been an interesting ride the last 18 to 24 months. And in my career in 25 years, you know, no curve goes straight up, right? I mean, there's usually ups and downs, peaks and valleys. And I think what we can expect is another good year for purchases just because the inventory is not there. There's a lot of people still that have money to buy. Rates are still really low. I mean, they're not the 100-year lows that we've seen, but I think there's going to be another great year of demand for housing, investment properties, primary residence. It's just really going to come down to enough houses to sell those people.
Well, I've noticed that the market just keeps going. There really wasn't a pause button like you normally see during the holidays.
You know, people took a slight breather like that. You know, normally there's a pause for a few months and people go, but you're right. You know, the buyers just keep coming, really. And I don't know what it would take to have that stop, because mortgage rates, while they'll go up this year, they're predicted to be around 3.5 through the year. That's still really cheap money. And so people are not fazed by the fact that they're not getting 2.5%. They're a little shocked at first, but it's all about the time that you're in, right? And so when they first went up from 2.5 to 3, there was a big reaction. But now, you know, people are hearing 3.99, 3.75, and they're just rolling right through it.
Well, and let's talk about the interest rates a little, because I remember when my parents bought their house, they paid 20% in the 70s. So 2%, 3%. You know, when I bought my condo in the early 2000s, it was 7%. And that's still a low interest rate when you think about what our parents did.
Truly. And you know, the one difference is the house prices are higher, but it's still at a difference in 1% interest rate is only about $70 a month on a payment, and people seem to just blow right through that. So it doesn't seem to be a problem for anyone. I think if you see mortgage rates get up in the 6.5, there might be a pause. But the market has an adjustable rate mortgage package that no one's seen in 15 years. And what happens on those is you get a 5-year fixed mortgage that's a point or two below the market rate. So even if they go up, there's going to be a solution. So I think we're always going to have a steady flow of buyers unless something big happens, we go into recession, you know, some type of economy, because people have to have housing.
Jeff, when you talk about interest rates, a lot of people know what an interest rate is, and they know that it's attached to the mortgage, but they don't know how it's created or who creates it or what it really means.
Yeah, so there's a market where mortgage-backed securities are bought and sold. And so there's prices and bids, and there's a regular supply and demand that happens in the financial markets. And so there's a price on the going interest rate. And when those banks offer it, there's a value over time for them to collect on it. And so that market changes every single day. And so depending on how many people want to come in and buy a home or get a mortgage dictates what the pricing is on mortgage rates. And so under normal market conditions, if those markets are allowed to behave normally, then if you have low short-term rates, you usually have high long-term, and vice versa. But what we've had the ability to have is the government has supported the mortgage market. They have done a thing called quantitative easing. So they've created the demand for mortgages, which has basically kept rates low. And so that just means that the federal government has purchased billions of mortgages every month, which has enabled the rates to stay low. Now, what's happening now is they're starting to pull that support out of the market, and they're starting to drift up under normal conditions.
And one of the great things about working with someone like you, Jeff, is you're a mortgage company. So you have access to all of these different types of mortgage loans. So if you go to a bank, you have to fit in their box. But with your company, you find a box to fit that person and their financial situation. And that's a big difference when you're buying a home.
And we feel like that the way that we deliver the loans to the market, that we get the best price, because Stockton Mortgage is a direct Fannie, Freddie, Ginnie mortgage originator, which means that we get the money directly from the agencies that back us up, and we think the price can be as good as it can be. We're never going to be the lowest out there. If you look enough, you're going to find somebody that'll do a mortgage for $10 and a pair of cowboy boots. But that's the service you're going to get. So I think finding the balance of the company that has the products, has a reasonable interest rate with closing costs, but can deliver your closing on time, that's who you need to pick. And that's kind of what Stockton Mortgage prides ourselves on.
And Jeff, I think it's really important for homeowners to know, lots of people say that we're in a bubble. We're not really in a bubble. We are in a housing market that's been flooded by a pandemic, right? On top of an already super fast housing market. The market is just flowing instead of overcorrecting. So there's not really a fear in purchasing a home.
And people have talked about the crash of '08. And there's one big difference, Kim. Lenders back then did not make people prove that they could pay their mortgage. So we as an industry, not Stockton Mortgage, we made a lot of exotic loans where we didn't prove the borrower's income, we didn't know how they paid, and all that's been corrected. So a lot of people say, do you think it's going to crash? And my answer is no. It's because people are going to still be able to pay their homes even if there's a market correction. So a cooling off maybe, but not a crash, not a bubble, not like we saw back then.
And Jeff, it sounds like that you're predicting another great year in real estate, and for homeowners or home buyers rather, not to be scared to make that investment.
Yeah, and we saw double-digit appreciation over the last 2 years, in some markets as high as 20%. And I still think that we'll have appreciation, but just maybe not that robust. I think we're still going to see 6 to 8%, and so that's still a sound investment, especially when the stock market starts to correct. You can count on your real estate at least to make money for you.
All right, well, thank you so much, Jeff. Really appreciate it.
I enjoy being here. Thanks for having me.
We'll be back with more My Southern Home in just a moment.